Hello and welcome to Basic Fundamental Analysis. It is so good to be with you. As you know, my name's Andy, and you and I are going to have a fantastic time in this field of study. There's so much to learn, and we're gonna bite off a big chunk of it today. I'll tell you what, this thing is packed with information. And we're going to learn so many new words, so many different vocabulary. You will see the world differently after this training is complete. I'll tell you that. So relax, kick back. I know we sent you a PDF, like a manual. You can kind of follow, fill in some blanks, things like that. But I'll tell you what, you'll have access to this more than once. So just kick back. You can retake this and fill in your notes later. My advice to people is to just soak it in the first time, and repetition's great. You can do it over and over and over again. So what are we going to cover? Well, a lot. Among a lot of things, we're going to talk about how to value something. Price is what you pay, value is what you get. So when you pay for stock, what do you get? Why do some people pay $300 a share for one, and others only want to buy a penny stock? What are you getting in return for this? So how do you even know what a good deal is and how to find them? So we're going to go through valuation for sure. We're also going to analyze stocks. In fact, if you have some stocks currently, we can show you analyze them. If you don't, we can get some practice ones. And we're going to show you how to do a fundamental analysis on your stocks. Very cool, very fun. We're going to use the computers to search for strong companies. Arthur Levitt, former chairman of the SEC, pretty good guy. He said this: our generation should be the most informed generation in the history of the capital markets. And the ease of this technology shouldn't be an excuse to do less. It's an opportunity. It's a mandate to do more, learn more, achieve more as individuals, as a country. I think that's pretty close to what he said. So we're going to do what he said. We're going to use the computer and leverage that. And boy, if you don't know how to use the computer, well, then ask your kids. They'll walk you through it, right? So, it's going to be easy. It's going to be fun. So we use the computer to search for strong companies. Vocabulary. I encourage everyone to get an accountant, an attorney, financial advisors, planners, brokers, all these teams. Easy to make lots of money when I got a team around me, right? So we're going to build a team. And it was amazing how much easier it was to communicate with this team as I work on my vocabulary. Same's true for you. It'll be easier to see things like the Wall Street Journal, easier to watch CNBC, because there's so much terminology thrown around in the world of wealth and finance that the more vocabulary you and I learn, the better off we are. We want to know what we're talking about, so we're going to do that for sure. You and we're going to discover how fundamentals relate to things like debt. We'll look at a balance sheet and the liability column. That's a debt, expenses. Sometimes there's a payment on debt. And we invest all over the world, so we got to know about currency a little bit. Inflation's kind of a concern. We're going to spend actually a great deal early on this topic. I think it's pertinent to our day. Not a lot of people understand how it works. So you and we're going to understand how it works, that's for sure. Also, got to find out how to set up criteria. Now, let me tell you, when I first started, set out and I made the decision, I'm going to learn how to invest. Going to get some training. I thought when I was finished with my training, I'd have this sixth sense, a gut feeling, and I'd be able to just have a feel for investing. It doesn't work that way. It's actually much better. All investing is setting criteria and finding investments that fit that criteria, and then you manage risk as you go along. That's all it is. Learn how to buy stuff, get some cash, a lot of fun. So tons more. I don't have room on just one outline slide to do all we're going to do, but before we do anything, got to keep it legal. I know you want to be protected, so do I. So let's protect ourselves and do the legal thing. Important legal disclaimer. When you invest in securities, stocks, options, all the stuff we talk about, that involves risk. Did you know that? I think you did. And so look, here's how we'll do it. If you decide to invest in some stuff, that's your choice. And if I invest in stuff, that'll be my choice. I might own some of the stuff that we talk about, okay? Maybe not. But I don't want you to construe that as like a recommendation for a specific security or even a vehicle or even a style. what I am doing here, what I think is best for you and I in this medium is let's just focus on our education, learning new words, learning criteria, and let's not, construe this into, advice and consulting and stuff like that. Hey, I think you get the message. Investing is risky. This is for grown-ups. Whole reason we want to get some education so we can mitigate some of the risks that's out there. I think you get it. It's for grown-ups, right? You got it. So let's begin by talking about your journey, and I'm going to take you through this journey. And I love doing it. My goal when I set this out is I wanted a program that could take people, and show them the way to go from A to Z. And I love being a part of that, especially at the beginning. So I see a lot of people what I call in phase 0. This is my continuum. You might have gone through this. If not, this will be important. If you have, it's great for review. So there are so many people that invest blindly. And so they have to trust someone else with everything. They're kind of hands off. They're stuck in this 401k that's not going anywhere. These mutual funds that they just say, hey, advisor, you drive the ship. And they don't ever have any involvement in those conversations. They don't ever have any ability to hold those guys as accountable as they might because they don't know how to talk to them and they're kind of at their mercy. And I see people with little or no financial education investing. Now, that doesn't make sense to me. Does that make sense to you? Do we want to invest in things we don't understand? That might be a good rule to learn right now. Should we invest in things that we don't understand? Boy, that doesn't sound like that's very smart because then I have to rely on others and I'm taking a risk. Do they know what they're doing? Maybe, maybe not. So let's make sure we know what we're doing and hop into phase 1. The first phase is awareness. There might not people that, they might not know there's an airplane or that an airplane exists. So the first thing we have to do is say, yeah, there is an airplane. It does exist. And so we start to learn the strategies here and we start working on that vocabulary. I'm really going to hit that hard. And we're going to learn about context. How do you think? How do you approach this stuff? So to learn that there is something you can do differently is the first step, to kind of be aware of what you don't know yet. There's the things you don't know and things you do. And we need to know that there's some things we haven't learned about yet. So we're going to do 4 classes. The first 4 classes, we're going to help you get more and more aware of what could be done. Of course, if you find out there is a plane, you might want to fly that plane. You got to be competent. And that's where you start learning very, very specific stuff. A lot more involved at the competence level. And the classes we'll do there are much more advanced. As a matter of fact, that's when the rules get specific and the details. You also get to select, your style. Maybe you want to trade the Forex. Maybe you want to be like me and trade options and things like that. So you're going to select your style at this stage and really get it down. So you take the written test as a pilot, and now you know how to fly a plane, right? Wrong. You got to take some time in the plane and practice. You've got to be proficient. And that's the final phase. No money's made unless you were good at what you did. And you can't just pass the written test to be a pilot. You've got to get in the car and actually show that you can fly and land and deal with weather and under pressure and all that cool stuff. So the education continuum takes people from awareness, competence, proficiency. If you will just go at a nice steady pace. Don't go too slow. It takes too much time. But do a nice steady pace. And go through your basic classes, enroll in your advanced classes, get your mentor and your market labs in where you're doing it for real in the market labs. Hey, I'll tell you what, next thing you know, you're trading stock, man. You've got a passive income that you feel pretty confident in. So that's the education continuum. We're going to start with awareness phase. This is your first class. And there are 4 things we're going to study. This is not like college where you've got to study history and you got an economics class and a geology class and a chemistry class and math class and literature class and all these other classes. No. There's 4 areas that you're going to study. Everything that's done fits in just 4 simple areas. I call them the 4 pillars of investing, and they will support you. If you have support from an education with these 4 pillars, you'll be strong. So the first one, that's today's topic, fundamental analysis, strength of an entity. How strong is this entity? They were talking about risk. Is there risk involved? Are they weak? Are they strong? Are they valuable? Great way to assess whether it's valuable. Fundamental analysis. Technical analysis, strength of the market. It's different. We'll talk about that next time, though. Don't want to take up all our time talking about technicals. We're going to do fundamentals. You can't control fundamentals and technicals, but you can choose your cash flow strategy. That's why you're able to make money every month, right? That's why you're able to do it. And things change, so you've got to manage the risk. And if you nail those 4 and you work hard on those 4 and you dedicate yourself to those 4, boy, you're going to have a strong education supporting you. So, fundamental analysis, what is it? Well, let's get the pen out and start writing stuff down here. The income statement, well, let's talk about that. That's the first half of things. The income statement is pretty much money coming in and money going out, just like you do in your life with your checkbook. You know, write a check, that's money out. Make a deposit, that's money in. If we take the income and we subtract the expenses, we get what's called a cash flow. And some cash flows are positive and some cash flows are negative. And we would like to have a positive cash flow, wouldn't we? So basically, you take your income, subtract your expenses, see if that number is positive or negative. Okay. Next thing we want to do is we want to look at our asset column. And assets is stuff that you own. And liabilities are things that you owe other people. Same math though, take your assets, add them up, subtract your liabilities, and that's going to give you equity. And once again, you'll either have a positive number or you'll have a negative number. And some people call that net worth. You know, you say, hey, I've got a negative net worth. Oh, better come to Andy and get some help. You know, got a positive net worth. Great, better come to Andy. Let's make it grow. So those are 6 numbers, aren't they? There's actually 7 that I'm going to have you use. But, you know, with those 4 even, you can get anything you need. If you have income, expenses, assets, liabilities, you can learn all kinds of things about this entity. It truly is the heart of a fundamental analysis. It's the financial statement. So that's awesome. Now, let's talk about different types of entities. I said this was the strength of an entity. Well, you're an entity. I'm an entity. We have personal finances. I know you have income and assets and liabilities and expenses. Corporations are just the same. They spend money and they bring money in through revenue. They buy things that are assets. They borrow money. They have liabilities, promises they make. And guess what? The country that you're living in, I've got my country here, the United States, but whatever country you live in, they have assets, liabilities, income, expenses. So look, we can see the strength, we can see the value, we can see elements of risk by looking at financial statements from these 3 types of entities. Now, what are we trying to do? Well, the thing that's a bear about investing, we're always trying to tell the future, aren't we? So we're going to learn a little bit. You know, boy, I don't have a crystal ball, and we don't have, you know, boy, it's tough to predict the future. So how do we do it? Well, the word I like to use instead of predicting the future is to say, what's most likely? You know, it can't be 100%, but what's the most likely? Hey, I'd rather doing what's most likely than what's least likely, that's for sure. So here's one thought on what's most likely. The velocity of a body remains constant unless the body is acted upon by an external force. That sounds like, that's confusing to me. That sounds like Newton or something like that. So what does that really mean? Well, if something's staying the same, it's got to get smacked somehow to move it. And if something's moved, it's got to get smacked to change it. And so that's called a force. Well, one of the things that changes how a financial statement looks is, and there's a lot of things that can change it, but the one we're going to work on the most today is something called policy. Now, I said there were 3 types of statements here. You know, we got personal, we got corporate. Let's do this. Let's start and let's study sovereign fundamental analysis. And you'll see why I'm going to work with sovereign right here, because sovereign's going to be a big deal, okay? So sovereign. So what is the policy, right? What is the policy that affects sovereign fundamentals? Well, let's take a look at it here. There are 2 types of policy in sovereign fundamentals. Let's use the United States for an example. The first one we got here is something called fiscal policy. And the second one is called monetary policy. Now that fiscal sounds like money and monetary sounds like money, so we must be somewhere in the right area, okay? So let's take a look at fiscal and monetary policy. Fiscal policy is set by Congress, okay? So let's say, let me just draw this here. This might be cool if I can do it. We'll draw it in white or whatever color we want, okay? So let's say that we have an income statement and a balance sheet right here. And yeah, I'm using my mouse to draw, so don't give me any grief if I'm not a perfect artist. We have assets, we have liabilities, here we have income, and we have, best I can do, expenses. So let's see what fiscal policy does. Well, fiscal policy right here, we'll just circle that in red. Fiscal policy does this. It does taxes and spending. Well, taxes would go here, right? And spending would go here. And if they have a deficit, right, if these two aren't equal, the deficit would go out here. That's all fiscal policy. They got to borrow money, the debt goes up. That's here. So these guys are in charge of what? They're in charge of income, and they're in charge of expenses, taxes, and spending. And I'll tell you, that's a lot of power. As soon as you start letting people tax you, they're messing with your property rights. No taxation without representation. Hey, I'm not going to get political on you, but I will say this. As far as the U.S. goes, we're spending a lot of money on stuff now that our kids are going to have to pay taxes on. Who's representing those guys? That's taxation without representation. Okay, enough politics. That's all I'll say about that. But monetary policy, let's use, how about green for that? Monetary policy, well, they have it in their idea that they can actually affect something called GDP. We'll put a G in there and a D in there and a P. We'll talk about that here in a minute. And they control what's called the money supply. And so that's the part that they try to impact right there. And they could do two things with this money supply. Let's say they lower interest rates. That's how much banks, where do banks get money from? Well, they get it here. And let's say that banks want to borrow money. Well, how much are they going to pay for it? So they control the cost of money. They control how much money costs to borrow and how much it costs to get. And that's interest rate. The other thing they can do, which is interesting, they can buy treasuries. And that's a pretty cool power. Now, a little bit about the Fed. A little bit about the Federal Reserve, just so you know that stuff right here, that's going to affect this right here, that's for sure. So, a little bit about the Federal Reserve here, real quick. You know what Congress is. That was set up. You learned about that in your civics class. But in school, they don't teach the Fed. The Fed is not federal. And it's not a bank, and it's not a reserve, so they call it the Federal Reserve Bank. Well, I guess that's to fake us out or something. I don't know. It's if you go to the Federal Reserve website, they'll say that they are independent operating within the government, which is, what does that mean? They have a whole bunch of central banks, and they are comprised with, I think it's 12 around the country, and they have something called the Federal Open Market Committee, and the chairman of this place is called Ben Bernanke, and before that was Federal Reserve. So they have a federal head, and Congress has oversight over these guys, but they're private. And you know what? They don't get to, the President of the United States can't even tell them what to do. They get to decide whether or not they're going to buy treasuries, and they get to decide whether or not to do the interest rate. And there's nothing Congress or the President can do about it. So a lot of power on this board, huh? Taxes, how much of your stuff can they take? And then two, you have this kind of quasi-private entity that decides how much money costs, and we don't audit the Fed. That's kind of scary. And we also have a bunch of investors and shareholders who we really don't know who they are, who ultimately own it, and they get to buy these treasuries. Interesting stuff. If you want to read about it beyond this, read Ed Griffin's book, Ed Griffin, called The Creature from Jekyll Island. Now that sounds like a monster movie. Well, it's not. Jekyll Island is a little island off the coast of Georgia, and in 1913, Senator Aldrich, who was related, of course, to the Rockefellers, he decided that they better start this central bank for all their buddies, and so they went down, secret meeting, code words, secret stuff, code names. They go down, they figured out this Federal Reserve, and they snuck it through Congress. And you think it sounds conspiracy? Sounds like it to me, too. So read The Creature from Jekyll Island. But anyway, how does this affect fundamental analysis? It's a huge deal. It impacts the money supply and also the GDP, and we're going to make this more and more clear as we go along. Now let's do the financial statement of the United States. We'll do it real easy. Now here's the thing. I'm not trying to get an accounting degree, and I don't think you are either. And so what we want to do here is we want to get concepts down. Now my good friends Robert and Kim Kiyosaki, they say an asset is something that you buy that puts money in your pocket, and a liability pulls money out. And everyone started to get upset with them because they would say, well, if that's the truth, then your house is a liability because it costs you money, doesn't make you money. And they say your house is not an asset. So, traditional accountants, they don't always see things the way we see them. But I'm going to say this. I think the biggest asset of the United States is that GDP. Now, what is that? Vocabulary word. Gross domestic product. What does that equal? That equals all of the money that was produced. That equals all the corporate profit. That equals all the salaries, all the commissions, all the wages. All the money that's made by both people as individuals and corporations is GDP. Now, why does the United States like GDP? let's pretend, let's just draw this over here for fun. Let's pretend that the GDP is a pizza. Okay? And what happens is they get to take a slice out of that pizza called taxes. That's right. And so they have taxes coming out of GDP. Now, there's a challenge with this here. There's a challenge with this. What if the GDP starts getting smaller? That's called a recession. In other words, if the pie starts shrinking, it starts going down in size. Let's draw a smaller pie here. Let's say the pie, we'll put it in the blue here. Let's say the pie gets smaller like this, see? Now there's just this little tiny piece of pie, and that means they don't have as much in taxes. And so Congress has a problem because they didn't make enough money. They didn't have as big an income, but guess what stays the same? Oh yes, we have to fight wars. Those cost money. We got Social Security and Medicare. That costs money. Debt service, roads, infrastructure, all the money that the United States spends, that doesn't change. And so this is called what? Fiscal policy. Do you remember that? Fiscal policy. Taxes and spending. How much money are we going to take out of that pie? How big of a piece of this pie? Well, if it's a small, maybe we just make the piece we take bigger. Maybe we take out a big maybe we take half the pie. Maybe we take 3/4 of the pie. See, it's quite a power, isn't it, that they have? They can take all the pie from us. And so how much do they take for this thing? Because we got to, so they have a choice. They can either increase the amount of taxes by taking, maybe they take the whole pie, right? They can either increase the amount of taxes, or they could decrease the amount of taxes. They can either increase the amount of spending they do, or they can make budget cuts. And they say, okay, the pie got smaller, so we're going to take a little sliver, and we're just going to have less expenses here, right? So that's fiscal policy. Well, right now, they had a big fight in Congress just recently, and boy, Standard & Poor's didn't like what they did. They even downgraded our credit rating. We'll have to talk about that. Because we operated a deficit. So in other words, when all said and done, they spend $1.6 trillion more than they brought in, and that's called a vocabulary word, a deficit. There's a lot of people think deficit and debt are the same thing. Nope. Deficit's just a shortfall. As a matter of fact, this would have nothing to do with debt. If you could go into the Treasury, let's build the Treasury right here of the United States, and here's, okay, that looks like a house, not a Treasury, but hey, put a couple columns on it, maybe we'll have a Treasury. If they had lots of money in the Treasury, then they wouldn't have to worry about that deficit. They just write a check out of their savings and they'd be covered. So deficit doesn't always have to do with debt. If you got plenty of money in the Treasury, hey, just draw on the Treasury, right? And if you didn't have a deficit, you'd have a surplus. You'd put more money into the Treasury and save it from all these taxes you collect. But we don't have a surplus. We have a deficit. And you know what? We don't have money in the Treasury either, so we have to borrow it, which caused another fight in Congress. You see, the Treasury only has so much money, and it actually doesn't last very long. And so the Congress saw how much money they were spending and how little they were bringing in, and the Treasury was running out of money, and they had a $1.6 trillion deficit, and they had to fight and say, we need to raise the debt ceiling because we need more money. So they raised the debt ceiling. We owe $14 trillion. That's called non-balance sheet promise. That's money that's been borrowed. And some of it's been loaned to us by pension funds, and some of it's been loaned to us by private citizens, and some of it's been loaned to us by other foreign central banks such as Japan and China, and that's a pretty big deal, isn't it? So $14 trillion we owe. This is not looking like it's very strong. See, fundamental analysis helps us see the strength of the entity. Now I'm going to teach you something here. How do we predict the future? Well, number one, we look at where this is going. How do we look where it's going? Here is a little formula. And you don't need to write this down. You can do it the next time we're together. You look at policy, right? Policy times demographics. We apply it to demographics. That equals the future. How about that for a fancy formula? Policy, and then you throw in that formula, you apply that policy to some demographics, and you will get the future. What are you gonna see in the future? So what we do is this: we say, who is collecting Social Security right now? Most of us aren't. Some of the disabled, some of the elderly are. Medicare, who's collecting that? We're not. Disabled, Medicaid, those don't have money. Medicaid, Medicare, yeah, they're not collecting it. But you know what? The baby boomers are getting older, and so that's called demographics. And we have a policy that says we pay this stuff to people of a certain age, and we have a demographic that's moving towards a certain age. So policy plus demographics equals the future. So think of it this way. Let's do personal. Let's say you buy a car on debt, and you owe $30,000 for the car, and that's a debt. That's on your balance sheet. That's an on balance sheet promise. But let's say that your son is growing up, demographics, and you say, son, when you turn 18, I'm going to pay for your college. Well, you haven't spent that money yet, but it's still a promise. And so that's your policy. I pay for my kid's college. That's our policy in our household. Kid's going to expect that. And sure enough, that demographic, he's going to turn 18 someday, and someday you will. That's called an off-balance sheet promise. So if you look at Social Security and Medicare and what that's going to cost, when you look at the demographics of those people getting older, $100 trillion plus, man. It's north of $100 trillion. And the problem is when we look at our GDP, and it's a little sluggish right now, the question is, can we collect enough taxes out of our GDP? We're already at 1.6 trillion short. We're collecting about 3 trillion. We're spending a little over 4 or something like that. Maybe collecting 2 trillion, spending 3. Hey guys, we can come up with 100 trillion. Our GDP can't do that. And so that causes some pretty big questions. It's called the bankruptcy pattern. Remember, policy and demographics equal the future. Policy applied to a demographic gives you the future. So the first stage in what I call the bankruptcy pattern is when you're operating at a deficit. Another word for operating is at a deficit, like we are over here where my pointer is, that puts you in something called insolvency. Insolvency means you can't pay your bills. It's not working. These programs, Social Security, Medicare, Defense, all this stuff, all these programs are insolvent because they don't pay for themselves. There's not a way to pay for them. They're not solvent. And so what happens is you got two choices. A, either start drawing off your savings account to try to keep up, right, paying the bills out of the savings account, or you have to borrow money to pay for them. And that's where we're at right now. We're borrowing money to pay for these programs. So that's called insolvency. Well, as soon as you're not allowed to borrow anymore, or as soon as all your reserves are gone, in other words, either you go to the bank account and it's empty, so then you start swiping your credit card until they hit their limits, and once no one will loan you any more money and your bank account's cleaned out, that point is where you go into default. And that is exactly where the United States was. And that's why they had a big talk in Congress, a big fights about tax cuts or increasing taxes or spending cuts or increasing spending or borrowing more money. Because they said, hey, if we don't borrow more money, we don't have any in the Treasury. We have no money in the Treasury, so if we don't borrow more money, if we don't raise that debt ceiling, we're going to default on some of the bills we have to pay. We're going to default. We owe these people this money. We're either not going to, pay this or that. We have to start choosing who we're going to default. And when you get enough default going on, that's the death of your nation or the death of your company or the end of the family. And what you have to do is you have to start over. You have to either restructure or the company just goes out of business in general. So certainly we don't want to die as a country. So what do? We got another secret weapon. We have a secret weapon that states don't have. We have a secret weapon that people don't have. We have it's not even a secret. It's just a weapon called quantitative easing. Now, you may have heard that term. You may have not heard that term. It's called quantitative easing over here. And quantitative easing tends to facilitate this thing going higher and higher and higher. It's a way to help the government loan money. And if it weren't for quantitative easing, it would be very, very difficult. It'd be harder for the government to loan money. So what is quantitative easing and how does it work? Well, it's a fancy word for printing money. Now, this is an interesting story. At least I think this is interesting stuff. So the United States is going to default. They were set to default in August of 2011. And so coming up to August 2011, they have these big fights in Congress. They're pulling, late night meetings, and the S&P says, look, if you don't get your act together, we're going to downgrade your credit rating because we don't think you're going to be able to pay these bills. We think you might default. And that's what a credit rating is, the risk of default. And they said, right now we don't think you'll default. You've got AAA credit, but if you don't behave, we might lower that rating. Well, sure enough, They raised the debt ceiling. They didn't get much done with their what? Their policy. And S&P did a report and said, we don't think you guys have a very good policy. Well, because of the bad policy and because of the major debt, because of the off-balance sheet obligation, because of all this stuff we see on the screen right here, $100 trillion in the future, $1.6 trillion deficit now, a policy that is not increasing taxes and that is increasing the spending. So we're having, we're not getting in enough revenue and we're making more promises. It's a mess. They said we're going to downgrade your credit rating. Well, Alan Greenspan is no longer a Fed chairman. He's not the chairman of the Fed, the Federal Reserve Bank, but he was there for a long time, and he knows he caused a lot of this stuff. So he took offense to that, and he said, "Hey, S&P," he said this the day after they lowered the credit rating. He said, "Hey, the United States can pay any debt it has because we can always print money to do that. That's our secret weapon. We can print money." How in the world does that work? How do you print money out of nothing, Alan Greenspan? I don't know. You must be smarter than I am. Why don't we start talking about how we print money? That'd be a cool topic to go through. Have you ever wondered why the United States can just print money? Let's find out. Let's see how it works. So, we're going to start this conversation by talking about how certain pieces of paper that we might call a note or a script or a certificate, how does a piece of paper get some value to it? Well, generally, it's not the piece of paper itself. Hey, it's just paper. I mean, you could throw it in the furnace maybe and heat your potbelly stove. But how does a piece of paper get value? It's what the paper represents, not the paper itself, right? And so notes and certificate usually represent something. So the key to understanding, paper money is understanding, well, what does it represent? For example, I might go and valet my car. I don't want to fight that parking garage. I don't know about you. I love having it just dropped off, let that valet pick it up and go park it for me. So that valet ticket is a certificate, isn't it? It certifies something. It certifies that I have a car that's in that valet garage. Well, what would happen if I just started printing a whole bunch of valet certificates, right? Now, this is called a silver certificate. And they used to use these in the United States. It looks a lot like a dollar bill. Looks like a Federal Reserve note does today, but it's a little different. This is called a silver certificate. They used to use these way back. And this also certifies some. It certified that I had ownership of a piece of silver in the Treasury. So rather than having to go to the Treasury and redeem my silver and then go buy something with the silver, I could simply give them my certificate, and now this person could go and redeem that silver in the Treasury on demand. And so that's how money used to be. It's a silver certificate. It's certified that it's some silver. Another certificate, a stock certificate. It's just a piece of paper, that's all it is, but it certifies that I actually own a piece of that company. That means I have a right to some of the earnings. If they have some earnings, I say, hey, some of those earnings are mine, and I can show you that they're mine. Why? I'm certified, man. I've got a certificate. So, valet ticket or a coat check certifies that you've got a car, a coat in the cloakroom. A silver certificate certifies that you have some silver. A stock certificate certifies you have some owner. So the paper in itself really isn't worth that much. It's just all three of those things that are made out of paper. But it's a certificate. It's something that's represented. Now, what if I just start printing valet tickets? Bam, 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 bam. I say, look, I got all these valet tickets. Well, that isn't going to work, is it? In fact, that'd be kind of fraudulent because I'm not increasing the amount of cars in the garage. I'm not increasing the amount of cars that I own. So I can't just print stuff out of nothing and say, here, I have all these cars now. No. It just wouldn't work. It doesn't represent anything at that point. They're forgeries. They're counterfeit. So we certainly can't do it with a valet ticket. Now, could we do it with one of these? Well, I blew this one up a little bit closely so we can read it. Let's start at the top, and maybe I ought to, I'll pull a little thing out here. It says here, right here, it says what? Silver certificate. And it says right here, this certifies that there is on deposit in the Treasury of the United States of America, skip down, $1 in silver that is payable to the bearer upon demand. So let's read that again. Silver certificate. This certifies, this piece of paper represents something, that there is on deposit in the Treasury of the United States of America $1 of silver payable to bearer on demand. We used to keep, a certain amount of, of money, about an ounce of silver for every 35 of these that we had, somewhere, or an ounce of gold. So, it's kind of the way it worked for a long, long time, and these have changed from time to time. But the biggest change came in 1971, because here's your problem: if you just go and print a whole bunch of these certificates and start printing them like crazy, well, you understand each certificate is a certification that you have a certain amount of silver in that treasury. And so if they just start printing these out of nothing like crazy, that becomes fraudulent, because actually they don't have that much silver in the treasury. And they started getting a lot of pressure put on them in President Nixon's administration. It was called Nixon shock. And Nixon said, hey, we got to change this. We need to be able to print money. So what we need to do is we need to change what this represents. Now let's back up a little bit. Boop, 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 boop. Remember, a note represents something. A valet represents a car. A certificate represented silver. Stock represented ownership. So he said, since we can't just do it this way, that'd be fraud, we need to change what this piece of paper represents. And so they thought, what could we represent? Another thing that's valuable, you could have a mortgage certificate, and a mortgage certificate simply represents a promise that you've made to pay something. A promise to pay. That's debt. Debt is a promise to pay. And what if they said, look, let's just make a dollar bill the actual piece of paper, and we'll back it, not with silver, but a promise to pay. And they call that the full faith and credit of the United States. Now that's kind of abstract, and that's why so few people can understand it, because they refuse to accept it. They say, wait a minute, it's got to be silver, it's got to be something. How can you just say it's a promise? Well, but there's a key. If they can get people to accept that, and just say, well, it's our word, it's our bond, it's our ability to collect taxes. I mean, look how much, we can take people's taxes, we can do all this stuff. So they turned it into debt in 1971, and notice how the certificate changed. No longer does it say on deposit is silver in the Treasury. They just said, what? This is a note. It's an IOU. It's a note. So actually, one of the ways you could look at a dollar is as a promise. That every time you have a dollar, you have a promise from the United States to back it by their full faith and credit. Very abstract concept, because it's a derivative of debt now, which is simply a promise, instead of a derivative of something physical, like a share of a company that builds products, or a share of silver, or a car. And that was the abstract concept, where we said we're going to just change money into a promise to pay. Debt, a Federal Reserve IOU, a note instead of a certificate. Interesting stuff. 1971 changed things. Well, what would happen if I printed more of these? Nothing. It's not fraud, because you're simply making another promise. However, think about your resources. What if I had a certain amount of resources? I had some hamburgers, and that was my resource. And I had some hot dogs, and I had some drinks, homemade root beer. Boy, this is sounding good. I'm hungry. Are you? We better stop. Have a lunch break. Nope. No stopping. No lunch break. So what if I promise you that you and I are going to have lunch? Well, if I have some resources, my resources in my fridge, I got ketchup, I got mustard in there, we got some root beer in there, whatever you want. I could probably keep that promise, because I have resources. However, what if I promise you and your neighbor and their neighbor and your neighbor and then another neighbor and then my neighbors and then of course my parents, and let's invite your parents, and let's start making more and more and more and more promises. Well, I can do that because I'm simply backing it with my full faith and credit. I actually didn't promise you a specific hamburger. I didn't promise you a hot dog. I just said, hey, we'll have lunch. I promise. I promise. I promise. Come on over. I promise. And I can make as many of those promises as I want. Whether I can fulfill them, well, that would be kind of interesting to find out. But yeah, because it's debt, I'm just making another promise. Just one more person I'm promising. So you might think of it this way. What if we were to print more stock certificates? What would that do? Well, this is going to be different. You see, this is more closer to printing money as is today. Let's say this building here, this company, they're cranking out $10,000 in earnings. So every year they make $10,000. They sell enough stuff that after everything's paid, they make $10,000. And they decide to print some certificates to show who owns this company. And let's say there's 10 certificates they print. And maybe one person owns them all, or maybe 2 people own 5 apiece, or maybe 5 people own 2 apiece. Maybe 10 people own 1. But whatever it is, they print up a share of stock that says this represents your right to these earnings. Which means that if we print 10 of them and they made $10,000, that means that each certificate, each guy that holds one would have a right to $1,000. That's pretty valuable. Tell you what, you get one of those stock certificates, you can claim $1,000. They have promised you part of what they have in the refrigerator, right? Part of those hot dogs, part of those hamburgers. That $10,000, you get 1/10 of it. You get it. And so that's cool. But what if they say, you know what? Let's just print more stock shares. Does that increase the earnings of the company? Does that increase their sales, their revenue, their value? So what if I decided I wanted to print 1,000 of these certificates? Not just 10 of them, 1,000 of them. Would that make the earnings go up 1,000 times? Would that make our sales, would it make this company 1,000 times more valuable? No, it wouldn't make it 1,000 times more valuable. In fact, it would make each certificate worth less. And so the more of them we printed, the less they'd be worth. Because now they'd only have claimed what? $10 each one. Because there's 1,000 shares out there. Well, that's very similar to what would happen. This is the full faith and credit. Now, value is kind of a hard thing for the Federal Reserve to understand, because when you go to work, you get money, you expect value. When I sell something on my business, people expect value when they hand over their money. So these guys are just going to make more certificates. They're going to make more notes, and it's related to the full faith and value. Well, what it really does is when they crank those out like this, adding more units doesn't increase the value of our country and our money supply is the same. The value of this company is the same. The value of our money supply is the same. And so when we increase the number of currency that make up our money supply, it's like cutting up a pizza, isn't it? That's what we did with this company's stock certificates. We didn't make the pizza larger. We just cut the pizza in 1,000 pieces instead of 10 pieces. Well, that's what we've done to our money supply. We haven't increased the size of the pizza. We just increased the slices of the pizza. And so we divide and dilute the money supply when this happens. Really interesting stuff. Well, this is Ben Bernanke, and he is now the current chairman, but he gave a speech a long time ago that I thought was interesting. Let's bring up his view of this. He says, what has all this got to do with monetary policy? He says, just like gold, the U.S. dollar has value only to the extent that they limit it in supply. In other words, there's not a very big supply of these things. Gold, you got to dig it up out of the ground. So that basically we can get away with saying these dollars have value. In other words, what we call a fiat currency. Did I say that? Did I say that? It became a what? A fiat currency. And what a fiat currency means is it's simply backed by the promise of the government. They deem it as valuable. Another word for this is called an elastic currency. They do a fiat currency, right? He says it's only valuable if you keep it limited in supply. Okay, but the U.S. government has a technology called a printing press. Today it's just an electronic equivalent, a keystroke, that allows us to print as many U.S. dollars as we want at essentially no cost. So we can control the value of a dollar through scarcity. If there weren't very many dollars out there, boy, it'd be hard to find them. You'd be having to work really hard just to get one because they're not around. But if we flood the market with them by increasing the number of U.S. dollars in circulation, or even by credibly threatening to do so, the U.S. government can also reduce the value of its dollar in terms of goods and services, which is equivalent to raising prices in dollars of those goods and services. So let's say that you want a gallon of gas, and it's $1 a gallon. Fine. But if you start making a lot of these promises, you start dividing up the money supply into more and more. Well, if you divide up the pizza, right, it takes more slices of pizza to get what you want in barter, right? And if you really cut up the pizza in many slices, you still got to come up with enough pizza to trade for gas. So the smaller the slices of the pizza, the more that you're going to have to trade for the gas, right? And so that's a good way to think of it, is it's not increasing the amount of value it has, it's actually decreasing the value and just cutting it in more pieces. In this case, the products do not gain any value, but the dollar loses value. Interesting stuff. So how does the Fed create this currency? Kind of an interesting mechanism. Not a lot of people know about it. Very important fundamental analysis on the sovereign level. Here we see the sovereign fundamental analysis of the United States, the balance sheet, the income statement, $1.6 trillion deficit staring us in the face. Well, as I said, the Treasury does not have that much money in there, and they're going to run out. You know, they said, hey, we're going to run out come August. Better do something, Congress. Better raise the debt ceiling. So how do they borrow the money? Do they go to a bank? Nope. Do they ask you and I? Yup. In fact, what they do is they issue bonds. Have you seen the new Captain America movie? I took my kids to see it. Had a great time. And it's really funny because, you know, Captain America, he's this military, you know, experiment basically. And they go, you're untested, you know. Who is it? Is it Tommy Lee Jones or somebody? Says, you're not tested, son. You're going to stay here in the thing. And they send him out in a chorus line to sell war bonds. So he goes around, does these little, you know, variety show or whatever, and he sells war bonds. Well, a bond is a debt. It's a promise to pay. So when you buy a war bond, you're basically giving money to the United States. You hold the bond, and then the United States is going to give you that much money plus a coupon, plus more, plus interest. So the Treasury really needs money to cover the deficit, right? So it borrows the money by selling Treasury bonds, right? And so the world has money. You know, the world has different currencies, and this is a great way for people to turn their currency into US dollars, great way to convert it. So they buy these bonds. And so what happens is they trade. Watch this. We're going to make a trade. Boop. Now the government has money, and it can pay its bills for a little bit, for a short time anyway. And now the market is flooded with these U.S. Treasuries. Well, you know, sure, this money will make it way back in the market, but, you know, if I'm holding a Treasury, that part of my cash is now tied up somewhere else, and I'm not going to be buying goods and services because I have a Treasury. Sure, that will go back in the economy somewhere else, but as far as me as a consumer, I can't go out and spend money now because I've got it tied up with the U.S. government. So I'm sitting with the Treasury. How am I going to go buy a new iPad when all I have is a Treasury? So that's kind of a problem when you're borrowing that much. People's money gets tied up in Treasuries. So how do we get this back into money? Watch this. Magic. Literal magic. Conjuring. Creating something where there was nothing. And that is the job of the Federal Reserve. There we go. Look at the hat. I don't know if they really have a hat or a wand. And this is another abstract concept. But what the Fed does is they buy those treasuries. In fact, they for a long time they would never buy them. They think, why don't they just buy them directly from the Treasury? Well, you know, they're starting to do that now. So, but traditionally they buy them from the market. Now watch this. When they buy those, they do it by writing a check. In fact, they do it in a keystroke. Remember when we said they had a printing press? They don't literally print them out and send them over. Okay, what they do is they write a check, and they write a check for treasuries. And people cash those checks for dollars. So dollars are created. And they now have stuff in their asset column. And someone says, wait. Andy, you said they weren't federal. You said they were independent. You said this was an independent body that worked within the government. So wait a minute. There are shareholders of the Fed that simply had nothing in their asset column. They get to write a check where no money existed in the asset column, but yet they hold the Treasury now in the asset column. Isn't that just like getting money for free out of nothing? Now the U.S. has to pay the Fed the money for these treasuries when the Fed didn't actually have to earn the money. That's what I'm saying. That's why it's so hard to get around that concept. Look at that. Abracadabra, bam. Now they have the Treasury bond on their asset column, and the market gets flooded with US dollars. That's called quantitative easing. That's why they do it, because they figure, hey, now that there's all this money out there, maybe people will spend it, and that will jumpstart the economy. But often it doesn't work in the long term. So now the Fed holds the bonds on their balance sheet. So let's learn some code, some vocabulary. Have you ever seen CNBC and Ben Bernanke said, we're going to print more money? Hey, he said it back here, remember? He said it here, but that was in 2002. Is he going to say that now? He's the chairman now. He can't say that. So what do they use? They use code words. And most people do not know the code word. So I'm going to tell you the code word. You ready? Here's the code word. Here we go. The code word for printing money, down here in the corner, keep the eye on the mouse, we're going to expand the balance sheet of the Federal Reserve. He stands up there at the mic. The Federal Open Market Committee from the Federal Reserve, they get up there and says, the Federal Open Market Committee has voted to expand the balance sheet of the Federal Reserve. That means that we're going to add assets in there. We're going to put more bonds in there. That's one way they say it. Another way they could say it is we're going to monetize the debt. Remember, we had all these bonds in the world. That's not money. That's not monetized. So what are they going to do? They're going to turn all these bonds into what? Into money. We're going to monetize the debt, or we're going to liquidate the debt, turn it into money so people can spend it and help the economy, hopefully. Or the other way they use, their favorite word is quantitative easing. Quantitative, they're going to increase what? The amount or quantity of U.S. dollars in circulation to ease the burden on the economy. And that short term sounds good. Short term, I'm not sure good. It's a good idea. Long term, maybe you and I should talk about the long term ramifications of when we do this. What do you think? Well, since there's a lot of money in there, there's now a huge increase in the amount of U.S. currency in the world. In fact, they printed trillions of dollars this way, created trillions of dollars. Now remember, they didn't increase the value, they just increased the number of pieces of paper. So it's kind of a tough thing because there's not an increase in the amount of goods that are being sold. So now you got all this money, but you don't have an increase in the goods. Thus, while the Fed has increased the currency supply, the demand for goods remains the same. Therefore, the currency's value decreases because there's an oversupply of currency, but there's not a big demand for it. So we're going to demand more of it. Since a dollar isn't as valuable, we now have to they want more of these dollars. They're everywhere. They want more of these dollars now in exchange for the goods that are still in limited supply. Interesting, right? The supply of goods or the demand for goods remains the same, but the supply of the currency goes up. Interesting stuff. And this has happened in history a few times that gives us pause, because remember, an object in motion tends to stay in motion. We can see the direction this is going.